I'm so glad you're here, ready to take control of your finances and learn how to make your money work for you. Today, we're diving into the exciting world of investing. Whether you're a complete beginner or have dipped your toes into the market, these 7 powerful tips will equip you to invest like a pro. We'll break down complex jargon into easy to understand concepts and empower you to make smart decisions for your financial future. And don't forget to stick around until the very end, where I'll share a bonus tip that could make all the difference in your investment journey. Let's get started. The power of compounding is truly magical. It's a concept that can transform your financial future in ways you might not even imagine. It's like a snowball effect, where your money earns interest, and then that interest earns even more interest over time. This continuous cycle of growth can lead to substantial financial gains. It's the closest thing to magic in the financial world. The beauty of compounding lies in its simplicity and its ability to multiply your wealth over the years. Think of it this way: the earlier you start, the more time your money has to grow exponentially. Time is a crucial factor in the compounding equation, and starting early gives you a significant advantage. Even small contributions made consistently over time can lead to significant wealth accumulation. It's not about how much you start with, but about the consistency and the time you allow your investments to grow. Imagine 2 investors, both aiming to retire at 65. Their financial journeys can be vastly different based on when they start investing. Investor A starts at 25, while Investor B waits until they're 35. Those 10 years can make a world of difference in their final retirement savings. Even if they invest the same amount, Investor A will likely have a much larger nest egg at retirement, thanks to those extra 10 years of compounding. The earlier start allows for more growth cycles. It's never too early to start, even if you can only invest a small amount each month. Every little bit counts and contributes to the overall growth of your investments. The key is to develop the habit of investing consistently and let time work its magic. Regular contributions, no matter how small, can lead to significant financial growth over the long term. Remember, the biggest regrets often come from inaction, not from taking that first step. Hesitating can cost you valuable time that could have been used to grow your investments. So, take that first step today. Start your investment journey now and give your money the time it needs to grow. Start small, stay consistent, and watch your wealth grow over time. With patience and regular investments, you'll be amazed at how much your financial situation can improve. Imagine putting all your money into a single stock only to see it plummet in value overnight. The financial loss could be devastating, and it might take years to recover. That's why diversification is crucial. It's a strategy that can help protect your investments from such drastic downturns. It's about spreading your investments across different asset classes, like stocks, bonds, real estate, and more. By doing so, you reduce the risk of losing everything if one investment fails. Think of it like building a sturdy house. A well-built house relies on multiple pillars for support. You wouldn't build it on just one pillar, would you? A single pillar could easily collapse under pressure. You'd want multiple strong supports to ensure stability. Each pillar adds strength and resilience to the structure. Diversification helps mitigate risk by ensuring that if one investment performs poorly, others can cushion the impact. This balance can help smooth out the ups and downs of the market. It's about finding the right balance for your individual goals and risk tolerance. Everyone's financial situation is unique, so your diversification strategy should be tailored to your needs. There are various ways to diversify. You can mix different types of investments to create a well-rounded portfolio. You can invest in different sectors, industries, and geographical regions. This global approach can further reduce risk by spreading it across various markets. You can also consider index funds or ETFs, which offer instant diversification by tracking a basket of assets. These funds can be a simple and effective way to diversify. Remember, diversification is not about eliminating risk entirely, but managing it effectively. It's a way to balance potential rewards with acceptable levels of risk. It's about creating a resilient portfolio that can weather market fluctuations and help you achieve your long-term financial goals. With a diversified approach, you can build a more secure financial future. Investing always involves some level of risk. Understanding your risk tolerance, how much potential loss you're comfortable with, is crucial for making sound investment decisions. Think of it like riding a roller coaster. Some people love the adrenaline rush of a steep drop, while others prefer a more gentle ride. Your risk tolerance will depend on factors like your age, financial goals, time horizon, and personal comfort level. If you're younger and have a longer time horizon, you might be more comfortable with higher risk investments that offer the potential for higher returns. On the other hand, if you're closer to retirement, you might prefer lower risk investments that prioritize capital preservation. It's essential to be honest with yourself about your risk tolerance. Don't let emotions or market hype lead you to make impulsive decisions that could jeopardize your financial well-being. The financial world is constantly evolving with new trends, technologies, and investment opportunities emerging all the time. To stay ahead of the curve and make informed decisions, continuous learning is key. Think of it like maintaining a car. Regular checkups and maintenance are essential for its smooth running and longevity. Make it a habit to stay updated on market trends, economic indicators, and investment strategies. Read books, listen to podcasts, attend webinars, and follow reputable financial news sources. Don't be afraid to ask questions and seek clarification on concepts you don't fully understand. Remember, the more knowledge you acquire, the better equipped you'll be to navigate the complexities of the market and make sound investment decisions. Investing without clear goals is like setting sail without a destination in mind. You might end up somewhere, but it might not be where you intended to go. Before you invest a single dollar, take the time to define your financial goals. What are you saving for? A down payment on a house? Your child's education? A comfortable retirement? Once you have a clear picture of your financial aspirations, you can tailor your investment strategy accordingly. For short-term goals, you might prioritize lower risk investments that offer stability and liquidity. For long-term goals, you might consider growth-oriented investments that have the potential to generate higher returns over time. Remember, your goals will evolve as your life circumstances change, so it's crucial to revisit and adjust them periodically. Investing is not a set-it-and-forget-it endeavor. It requires regular monitoring and adjustments to ensure you're on track to meet your financial goals. Think of it like tending to a garden. You wouldn't plant seeds and then never water or weed them, would you? Market conditions change, and your investment strategy should adapt accordingly. Don't be afraid to rebalance your portfolio if it's become overexposed to certain asset classes, and don't hesitate to cut your losses if an investment isn't performing as expected. Remember, staying engaged with your investments empowers you to make informed decisions and stay on course towards your financial aspirations. Navigating the complexities of the financial world can be daunting, especially if you're new to investing. The sheer volume of information and the rapid pace of market changes can be overwhelming. Or perhaps you lack the time or expertise to manage your investments effectively. That's where seeking professional advice from a qualified financial advisor can be invaluable. Think of it like hiring a personal trainer for your finances, someone who can guide you through the intricacies of financial planning. They can provide personalized guidance, tailored strategies, and ongoing support to help you achieve your financial goals. A financial advisor can help you navigate the financial landscape with confidence and clarity. Develop a comprehensive financial plan that addresses your unique needs and objectives. Create a diversified investment portfolio aligned with your risk tolerance and financial aspirations. Navigate market fluctuations and make informed investment decisions based on thorough market analysis. Optimize your tax strategy to ensure you're not paying more than necessary. Plan for retirement and other long-term financial goals, ensuring you have a secure and comfortable future. Remember, choosing the right financial advisor is crucial to your success. Look for someone who is certified and experienced with a proven track record of helping clients achieve their financial goals. Ensure they are a fiduciary, meaning they're legally obligated to act in your best interest, putting your needs above their own. They should be transparent about their fees and services, so you know exactly what you're paying for and what to expect. A good communicator who explains complex concepts in a way you can understand is essential. Seeking professional advice can provide peace of mind, knowing that your finances are in capable hands. With the right advisor, you can confidently pursue your financial goals and build a secure future. Congratulations on taking this important step towards securing your financial future. Remember, investing doesn't have to be intimidating. By following these 7 tips, you can approach it with confidence and make your money work harder for you. If you found these tips helpful, please give this video a thumbs up and subscribe to our channel for more empowering financial advice. And don't forget to hit the notification bell so you never miss an update. Remember, the best time to start investing was yesterday. The next best time is today. Start small, stay consistent, and watch your wealth grow over time.